makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that White House budget director is planning to swiftly dismiss federal workers within 1 to 2 days as the government shutdown enters its second day.
We are going to have to lay some people off if the shutdown continues. We don't like that. We don't necessarily want to do it, but we're going to do what we have to keep the American people's essential services continuing to run.
This comes as the Trump administration targets Senate Democratic leader Chuck Schumer and House Democratic leader Hakeem Jeffries, both of whom represent New York in Congress, by halting $18 billion in federal funding for infrastructure projects in New York City. Now let's bring in Bloomberg's Valerie Teitel for more. Val, how are the markets reacting to this? Not much.
Not much. Frankly, what the market told us yesterday is that a government shutdown is bullish for global equity markets. We had many global indices notching record highs in yesterday's session, adding to them today, whether that's the FTSE 100, the Euro Stoxx 50, or over in the U.S., the S&P 500 and the NASDAQ, both notching record highs. And the enthusiasm doesn't end there. MSCI Asia Pacific also notched another record high in the Asia session. So global stocks at record highs amidst this government shutdown. It was all really down to the weak ADP data yesterday that really had cemented in traders' minds that this Fed cut in October is well into place. We saw a decent rally when it comes to two-year yields in yesterday's session, Francine. The biggest rally in the front end that we've seen for over a month now. Those two-year yields moving some 7 basis points lower in the session yesterday. The ADP figure, the market is really hanging their hats on it. Given we won't have jobless claims, we won't have NFP this week to give us a better steer on the labor market. But the breadth of the weakness in the ADP report was quite deep. Over 70% of industries said that they were reducing their hiring. Now, when it comes to the data that is at risk of delay, jobless claims today, we are not going to get from the BLS. Some individual states will still be reporting their numbers, but really the market's attention is on NFP. The BLS still needs a few days to finish this survey. So even if the government shutdown ends next week, it's unlikely we'd get this data straight away. We'd be waiting for an update from the BLS on their rescheduled date.
Valerie, thank you. Valerie Teitel, with a look at the U.S. data there. Now, we're just getting also some breaking news out of Monte Paschi. Now, Banca Monte Paschi's purchase of Mediobanca could mark the start, we understand, of a new wave of consolidation for Italy's banking sector. This is according to the chief executive, Luigi Lovaglio, who's come on the program a couple of weeks ago, now speaking to our colleagues over in Rome. And out of that, the main thing is that basically he will be much more aggressive, or he seems to have appetite for more. It could mark the start of a new wave of consolidation for Italy's banking sector. We don't know what he'll go after afterwards or how much he'll pay for it, but certainly it's an interesting development. This is according to the Mediobanca CEO speaking in an interview for Bloomberg's Italian language podcast, Quello che I soldi non dicono. Now, as Val was saying, the U.S. shutdown means markets having to contend with a lack of official economic data from the world's largest economy. The Chicago Fed President, Austin Goolsbee, says this poses a problem for policymakers.
The data dogs are howling because, we're not getting our usual supply of information. I will say, I consider the Bureau of Labor Statistics job data to be the absolutely best data source on jobs and statistics in the entire world. If we aren't going to have those, it's problematic. That said, the Chicago Fed has come out with some new job market indicators, and we'll be releasing them tomorrow.
Well, joining us now, Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management. Kim, as always, thank you so much for joining us. I mean, there does seem to be like a full conviction in the markets that the Fed is ready to cut, full stop.
Yeah, I think even, with this data not being available at the moment, I think there is enough in the data, the weakness in the labor market, to see the Fed, on our view, to cut 3 more times into the first quarter of next year. I think if you really dig into the labor market data, it's not just the AAI structural story. It's not just the lower immigration story. You are seeing that cyclical demand weakness. And I think the clearest part to this puzzle is wage growth. And there is a lack of wage growth in the U.S. If you are in the U.S., the difference between your wage growth of a job stayer, a job switcher, that's no longer any difference. And surveys keep pointing to wage growth, more weakness in wage growth to come. So we think there is enough for the Fed to cut, and we don't see the inflation side of the mandate being a challenge to these 3 cuts either.
I mean, what's the right way to think about it? Go big and then see what the effect is, or actually gradual cuts?
I still think it's gradual risk management cuts. You do still have upside risk to inflation, although we don't think it's going to stop that gradual mantra. But I think to do something faster than that, you are going to have to see a negative payroll print, unemployment rising at the same time, and getting claims rising as well. And on the inflation side, we see pretty clear disinflation coming in services, from rent, from wage growth. But we are only about a third of the tariff pass-through into goods. So there's still 2/3 to come. So there is going to be upside pressure, but the magnitude has been smaller than expected. I think businesses have learned to adapt in different ways. Inflation expectations are still anchored. That then gives the Fed enough to cut gradually, but not more than that.
When you look, Kim, at some of the biggest, hottest debate is basically what inflation does next year. Does that change the thinking of Jay Powell?
Yeah, so this was actually the bigger part of our debate at our recent investment quarterly, what the inflection point for the U.S. economy is going to be next year. I think for the first quarter, the balance of risk to growth is going to be more balanced. So the Fed would have cut a few times. You then get stimulus from this One Big Beautiful Bill Act, hit the economy as well. Then the question of whether that is actually net positive for the economy or just an offset to the tariff-related weakness will depend on just how weak the economy becomes in Q4 this year. But then if you look even further ahead as well, we're almost a year away from the next U.S. midterm elections, believe it or not. And the question for us is then, are you going to get more fiscal stimulus from the U.S. administration then, maybe some deregulation at the same time that the Fed chair is probably going to be more dovish?
Kim, but at the same time, earnings are actually not too badly at all. So we have chief executives sometimes like sitting on their hands saying, look, I'm not sure what I'm investing into, so let me not invest the 100 million, 200 that I was going to have to spend. But how do you match up the two, like, what the economy is doing and actually earnings being more than fine?
Yeah, I think it's the classic K-shaped economy. I think earnings are looking good because firms are cutting costs. They're not hiring. We see that in the labor market data. But at the same time, they are really increasing capex, so investments. And that K-shaped economy is just going to continue, I think. But again, the Fed's mandate is labor market, it's inflation. So I think the labor market weakness will still lead the Fed to cut.
Kim, let's also talk, of course, about some of the tech stocks. Bloomberg has learned that ChatGPT maker OpenAI has completed a deal at a valuation of $500 billion, making it the world's most valuable startup. Now, for more, let's bring in our Bloomberg's deal reporter, Manuel Baigorri. Manuel, so good morning, first of all. Give us the details of that share sale.
Hello, Francine. Yeah, fantastic deal, right? A remarkable valuation, $500 billion, becoming the world's largest startup right there. I mean, we've seen a number of secondary transactions in some of the most fashionable tech companies these days. There is a lot of pent-up demand from investors to jump into the bandwagon. And at the same time, these companies need big liquidity events to try to reward and retain talent. And that's what we are seeing right now, right? Like current and former employees sold $6.6 billion worth of stock in OpenAI. And that provides liquidity to them. It's also a way not only to reward some of that, but also to try to retain some of that talent. Let's bear in mind that this has become one of the most competitive fields out there, and companies are really pushing hard to retain employees. We've seen the likes of Meta, for instance, poaching company employees, from other rivals as well. So that continues to be a trend. And at the same time, companies like OpenAI are deploying a lot of capital into new products, into infrastructure, and so on. So they need a lot of investments to keep up growth pace as well.
Manuel, thank you so much. Bloomberg's deals reporter there, Manuel Baigorri. Now, Bloomberg has also learned that Apple has hit pause on a plan to overhaul to its Vision Pro headset. Now, it's said to be redirecting its resources towards developing smart glasses to rival product from Meta. Sources say Apple had been preparing a cheaper and lighter variant of the headset for release in 2027, but that those plans have now been shelved. We're back with Kim Crawford. Kim, I know you're global rates portfolio manager, so you don't look at some of these earnings or some of these quirks, but is there any, I don't know how quickly we can start talking about technology or AI may be changing the economy, therefore would also change the models that the Fed is looking. Is that 2-3 years, or do we need to start thinking about it now?
Yeah, it's something that we are looking at closely. What level of unemployment rate is the new NAIRU, where inflation pressures then matter to the Fed? Maybe that changes. I do think it's early days, and we have to see as well just how long the AI cycle can continue. But we're just going to have to keep watching it.
I mean, how does the Fed look at, again, the shutdown? I know they're looking through it. It's just a lack of data. But could it have more permanent effects if, the Trump administration uses it differently to past administrations?
Yeah, so historically, the macro implications haven't been large. Partly, we didn't have these firing of the federal workers as well in past shutdowns. But I think it's all a question of how long it lasts. Historically, the longest that it has been 2 weeks. That's just been a temporary effect on the economy. But the longer it lasts, the more the non-linear effects will kick through. Paychecks don't arrive, consumption gets hit. But for now, we're not expecting it to last for longer than that.
Kim, talk to me about the Bank of England. So we had a fantastic interview yesterday with Catherine Mann, who's talking about inflation, and actually the fact that she's still worried about inflation, where many of her colleagues, certainly on the MPC, are not. What are you expecting the BOE to do?
Yeah, I think it's going to be a slow burn for the Bank of England. The data is moving in the right direction, but just very slowly. So inflation is still sticky, like Mann talked about. Services inflation is at 5%. Wage growth isn't far from that either. So there's not a lot the Bank of England can do at the moment. At the same time, activity data, it's not strong, but it's not weak enough to really pull inflation down. I do think the growth narrative will continue to weaken, though. We get the autumn budget news. I think that package there should be contractionary, weigh on growth further next year. And you still continue to see slack growing in the labour market. So all those should pull wage growth and inflation down. But I think it's just going to be quite a while. On our estimates, core inflation only really comes back below 3% in the UK spring of next year.
I mean, Catherine Mann really made me laugh because she was talking about, the boogie interest rates. Like, it's up and down and you're like dancing all the way around. When are you expecting it to cut? Is the next move definitely a cut? And actually, how quickly could that come?
Yes, I do think it's a cut. I think primarily the growth data is still weak. It's just going to take time to feed through the economy. Like I said, core inflation comes below 3% in spring next year, when a lot of these resetting of the administrative prices happen and the base effects pull inflation down. I think that's probably that's my base case on when the Bank of England will be able to cut. But if there is very clear signals from pay settlement data at the end of this year, or the labour market really materially weakens very quickly, then they can go earlier.
I mean, the ECB seems to be in a better position. I don't know whether that's because they just front-loaded some of the cuts, and so they can afford now to see what happens next.
Yeah, I think the inflation picture has just been almost the easiest. Yeah, it's just very different in Europe. So yeah, I think the ECB it's a very clear message from them. They are done for now. They're very happy with where they are. You need to see a real material deviation from and sustained deviation from the inflation target in order for them to cut again. I think the proof will be in the pudding, though, in Q1 next year, when inflation actually is at 1.6%, whether the majority of the General Council members are willing to still stay on hold with that data.
I mean, what are you expecting when you look at, some of the defense spending from Germany? I know that there was a little bit of a boom in the market. It's expected, but it's not really expected to even filter through 2027. I don't even know if it's next year, actually.
Yeah, so we're already relatively optimistic on German federal spending, but it is going to take time. Like, defense can happen a bit quicker, but the multipliers are going to start lower because a lot of it's going to be import content. And then on the infrastructure side, there are constraints to just how quickly they can ramp it up. That being said, I think there has been good progress that has been made over the summer. There are multiple procurement acceleration acts that have been passed, reducing regulation. So I think the government is making all the right steps. But even with that, don't forget Germany is a quarter of the Eurozone economy. So for it really to stoke inflation at the Eurozone level for the ECB to react to, I don't think that's for the next couple of years.
I mean, France is still a bit of a mess politically because we don't know whether the budget passes, when it passes, with what inside. Do you favour, what do you buy in terms of European bonds?
Yeah, so France, I think, we're going to have a compromise between the government and the Socialist Party, not quite the 4.7% that Le Cornu currently has on the negotiating table. I think it'll be more like 5%. But for us, it's still a structurally quite weak and deteriorating story, just given how fragmented Parliament is there. So our top picks in Europe are Italy or, say, long-end European Union bonds. I think that's where value is still attractive. Politics are stable in Italy. They have been for a while, but the next general election isn't for the next 2 years. The message around fiscal discipline has been very consistent, and we're seeing even incrementally positive upside news. The deficit in Italy was 3%, supposed to be 3% next year. They might even hit that this year because of better than expected growth and tax revenues. That contrasts to something like France, which is like targeting 5%. So those are the two things that we like in Europe.
So interesting, Kim. As always, thank you so much for joining us. Kim Crawford, their Global Rates Portfolio Manager at JPMorgan Asset Management. Coming up, Arab leaders are pushing Hamas to accept Trump's plan to end the war in Gaza. This comes as Israel intercepts a flotilla heading towards Gaza. We'll have the latest from the region next. And this is Bloomberg. Now, Arab and Muslim national leaders are pushing Hamas to accept the Gaza plan unveiled by President Trump, saying the need to end the fighting surpasses concern about the finer details. Let's go to Dubai now and speak to Paul Wallace, Bloomberg's managing editor for Middle East and Africa. Paul, how are efforts going to push Hamas to accept the proposal to end the war?
Hi, Francine. Like you said, Arab states such as Qatar and Egypt and others like other Middle Eastern states like Turkey are pushing Hamas quite hard on this, according to our reporting. They want the group to accept the plan, the 20-point plan unveiled by Donald Trump on Monday evening. I think at this stage, it's still unclear when Hamas will respond. Donald Trump sort of, in a vague sense, gave them until tomorrow or Saturday to come back with an answer. I think there's a very good chance that Hamas doesn't flat out reject or accept it, but comes back and says, look, it's essentially okay, but there's some points we need to negotiate and get clarity on. It's probably around things like the speed of the IDF's withdrawal from Gaza. So I think we could still be in for several more days of waiting until we know whether this plan will result in a ceasefire or not.
Paul, at the same time, a United Nations Commission report concluded last month that Israel was committing genocide against Palestinians in Gaza. What do we know about leaders worldwide trying to put pressure on Netanyahu?
It's the pressure on Netanyahu and the Israeli government as a whole has certainly been growing, and it's almost not that much of an exaggeration to say that beyond the US, Israel really doesn't have support among world powers for the continuation of the war in Gaza. If you look at Europe, I guess that's where it's been most startling. It's there's fierce opposition to almost everywhere to Israel continuing this war. They want it over. We saw last week at the UN General Assembly in New York several countries, allies of Israel, pretty firm allies of Israel, unilaterally recognizing Palestinian statehood. Places like the UK, Canada, Germany, Australia. That did not go down well with Israel at all, and even the US said it was a bad move. But the point is, pressure is growing, and I think you could see that on Monday when this plan was announced in Washington by Trump. Benjamin Netanyahu was alongside him. He looked, Netanyahu didn't have quite the same energy as he usually does, and he certainly had to concede some things in this plan that was announced. There was wording about potential Palestinian statehood. Eventually, Hamas fighters who surrender will be given amnesty. Things like that, which have made this a pretty hard sell for Netanyahu to the far-right members of his cabinet. So that pressure is growing on in Israel. And if Hamas does come back and say we want to clarify certain things or tweak certain things, I think there will be a lot of pressure on Israel to basically go back into negotiations, at least in the short term.
Yeah. Paul, activists on board a flotilla sailing towards Gaza also say that the Israeli Navy has now intercepted 3 of their boats. What more do we know?
So far, it seems to have gone off, this interception has gone off pretty smoothly as far as the Israeli Navy is concerned. They've intercepted some boats. It's a big flotilla, I think about 44 boats or something like that. They've intercepted some of them, including the one that Greta Thunberg was on. The activists on those have been taken to an Israeli port, and they'll probably be deported to Europe in the next 24 hours or so. There have been no reports of violence or casualties so far, but it is a developing story. And like I said, it is a big flotilla, and it sounds as if at least some boats are still out there. So there's still the potential for something to go wrong and for there to be violence or casualties among either Israeli Navy personnel or the activists themselves.
Paul, thank you so much for the updates. Paul Wallace there with the very latest, of course, on the Middle East. Also making news, the U.S. Supreme Court has refused to allow President Trump to immediately fire the Fed Governor Lisa Cook while she sues to keep her job. Now, the order issued Wednesday means that Cook can remain in her position at least until the justices rule after hearing arguments in the case in January. Now, the decision deals a setback to Trump's efforts to exert more control over the central bank. And U.S. President Donald Trump says he will press Chinese President Xi Jinping to restart purchases of soybeans when the two meet at the end of the month. Well, China has not bought a single soybean cargo from the harvest now underway, instead relying on Argentina and Brazil. Well, American farmers are increasingly worried their crops will go unpurchased this year without a trade deal with Beijing. Tesla shares have soared recently, climbing 33% in September alone as investors rally around the chief executive Elon Musk's renewed focus on the company. That's drawing attention to whether key third-quarter sales figures due before the U.S. market open today will be strong enough to sustain the momentum. Well, let's talk to our Kartzar, our global automotive editor, less boring title, Kartzar, Craig Trudell. Craig, thank you for joining us. So what can we actually expect from these third-quarter sale numbers?
When we look at the consensus, it's a story of sort of less bad, a small year-over-year decline in the third quarter. I think we did see a lot of analysts as the quarter was coming to an end, actually come out with estimates predicting a small increase actually from a year ago. So we'll see whether some of that optimism that maybe helped drive the shares even higher toward the end of September comes to pass. I think the big question, of course, is how much of this can be sustained because of the effect that the tax credits in the U.S. going away sort of drove so much momentum, not just for Tesla, but for the broader industry, where every manufacturer that had EVs to sell in the third quarter was selling a heck of a lot more of them in the U.S. because you had a lot of consumers sort of knowing that this $7,500 tax credit was for the taking and not for any longer than past September.
Yeah, and the stock is also something we need to watch out for, right? Because it's been going great for the moment. Craig, as always, thank you so much. Too short a time. We'll have to get Craig back on. Craig Trudell there. Now, coming up, an acute lack of new developments has caused a severe supply squeeze in the London office market. We'll be discussing this and more with CBRE's Esteban. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The White House plans to use the shutdown to fire federal workers. Meanwhile, the Fed's Austin Goolsbee warns the delay to data will make it harder for rate setters to interpret the economy. OpenAI's valuation rises to a record $500 billion after a share sale, overtaking SpaceX as the world's most valuable startup. Plus, tech stocks drive global markets to fresh highs as stocks shrug off the U.S. government shutdown. So European Union leaders are building momentum for a plan to loan Ukraine 140 billion euros from immobilized Russian central bank assets. The proposal has gained backing from several EU nations and comes as European political community leaders meet in Copenhagen today.
There's a growing consensus among us that it's not only the European taxpayers that should pay for the support to Ukraine, but that Russia has to be held accountable. Russia is the perpetrator it has caused the damage, and it has to be held accountable. And I think we have now a sound legal way to do this.
Well, for more, we're joined by Oliver Crook, our Chief Europe Correspondent. Ollie, always great to have you on the Pulse. What can we expect from the meeting?
Yeah, Francine, so for the European political community, remember, this is the largest format of European leaders that ever meet in the sort of European Union. It's a meeting that was devised by Emmanuel Macron after the invasion of Ukraine, and this is the 7th one. And this is everybody from the EU to the United Kingdom, Norway, Turkey, to all sort of discuss a number of different issues. Of course, principally, the last few years has been a focus on defense. But what was really sort of interesting yesterday was when EU leaders held their informal meeting in preparation for their formal meeting, which is just a couple of weeks away. And what we're gathering there is the topics of Ukraine and defense momentum on two issues. The first is that loan that 40 billion euros worth of basically on the Russian immobilized asset. The European sort of nations will sort of back a loan that would be sort of guaranteed as collateral of those Russian assets. And this, you'll remember, Francine, has been a massive debate within the European Union. What to do with those immobilized assets? Is there a legal way to basically monetize into the future?
Okay, I think we're having a little... we can hear Oliver. I mean, it's in and out, so we're having connection issues. Breaking news. We'll get back to Ollie in a second for a full round of exactly of that meeting in Copenhagen. Now, also, French unions are holding a new round of anti-austerity protests today, seeking to maintain pressure on Prime Minister Sébastien Lecornu on his expected budget proposals. Now, walkouts are planned in sectors including education and transport. Air traffic disruptions should remain limited, with only Paris-Beauvais Airport expected to reduce flight schedules. High-speed trains and the Paris Metro should run normally. Now, switching to the UK, and it's been reported that the government is weighing a plan to exempt shares of newly listed companies from a tax on trade. Now, according to the Financial Times, the Chancellor, Rachel Reeves, could announce up to 3 years of relief from stamp duties for newly listed companies in her budget next month. The tax is seen as a key drag on the City of London. And staying in the UK since the pandemic, London office vacancies have more than doubled. But a shortage of new projects has created a severe supply squeeze for top-tier accommodation. Now, rents are climbing sharply in the most coveted districts, especially for the few new developments nearing completion. Well, joining us to discuss the outlook for commercial real estate is Anna Esteban, Managing Director of Leasing and Occupier Accounts for Europe at CBRE. Anna, thank you so much for joining us. What do you see as the most surprisingly, developments at the moment? People seem to be going back to work, maybe not full-time, but there's much more appetite for premium properties.
That is the case, and we're still seeing, despite people coming back to the office and occupancy levels stabilizing, there's still a gap between what employers are expecting, which is 3+ days at the office, and what employees are delivering, which is 3-, and that gap is especially significant in financial and professional services companies.
So what can you tell us in terms of how, office spaces are being changed to 4 or 5 years ago? Do people want it differently? Is it location, or is it actually inside how they're done?
Well, I think the definition of offices has changed overall, and that's probably post-pandemic. And they're not only a container of activity, they're a very valuable part of the service delivery and the talent attraction and retention tools that a company has in order to make sure that they get the best people in the office. So they're designing these offices in order to make sure that people don't have to go to the office, but they want to. And that's why we're seeing this polarization in the real estate markets between top tier, not only locations, but assets, and the secondary or more peripheral locations with maybe less public transport, less car park facilities, maybe less collaboration spaces. So we are seeing a big difference between these two kinds of locations.
Anna, how is AI actually impacting company space needs, and how do you expect it to impact it even more going forward as we use AI more?
Well, I think AI has two effects. Obviously, one in data centers, we can discuss a bit later, but on offices, it's the space planning that is tough for companies. When you sign a lease, you usually sign a lease, especially for a big headquarter project. It may be a 5, 7, 10-year lease, and it's difficult for companies still to predict the effect of AI in their workforce. And that's why we're seeing a lot of shift into flex models, managed spaces, and a bit of agile models in which they don't have to commit to that space for so long because it's difficult for them to predict their headcount needs in the future.
How are RTO trends different across the markets you cover?
The trends you mean between the countries or the asset classes?
All of them.
So we're seeing, I think trends are very common in Europe. So we're seeing offices in industrial logistics maybe with softer demand, and we're seeing a differentiation and a polarization, especially in the office sector between, as we said, the prime offices and the periphery. We're seeing retail performing very well, consumer consumption is good, and we're seeing strong demand for very prime locations and some of the prime shopping centers. And we're seeing then data centers and residential, I would say these are the sectors that are growing the fastest in most of our countries.
Is it new builds, office spaces that people want, or actually things that have been retrofitted? Does that make a difference, and does it change for country to country?
I don't think it changes country to country. I think because public transport accessibility is a key factor when deciding the location, centric locations are the ones that are more sought after. It's difficult to find new developments in central locations, so there is a lot of redevelopment and refitting of existing buildings into new offices. And
in London, we've written about how large companies are struggling to find suitable space. Are you seeing a similar phenomenon across Europe?
Yes, and that's causing something that we had never seen before. Usually when you have higher vacancy rates, the rents get softer because there's obviously more supply than demand. But we have both increasing prime rents and increasing vacancy rates because of the concentration of demand in this kind of location. So we are, yes, it's indeed having an effect on both the availability and the rents in these locations that are more sought after.
I mean, when you look at, for example, the green credentials, is that something that's still being prioritized, or is that moving to the wayside?
No, it is being prioritized because it is a value preservation play. Yeah. So whilst the legislation comes and goes and the pressure comes and goes, everyone knows that in the mid to long term, that is something that will maybe be regulated. So everyone, especially for long leases or for investors who are investing in long-term assets, they all want to make sure that they have the green/ESG sustainability factor covered.
How are you expecting rents to actually change in the next couple of quarters?
For office.
I
think we will still see there's still pressure in the central locations and in the buildings that have these amenities, these ESG and sustainability certificates. So I think we can still expect rents to increase in the next couple of quarters, but we will see also vacancy rates and rent softening in those areas that don't comply with those criteria.
Anna, thank you so much. Anna Esteban, they're Managing Director of Leasing and Occupier Accounts for Europe at CBRE. Now, the Chief Executive of the London Stock Exchange says the flagship market is not for sale, even though it could have a willing buyer and rival Euronext. Speaking at Bloomberg's Women Money Power event, Julia Hoggett also made the case for the UK to change its pension fund policies to better support domestic companies.
You asked about mandation. For me, it's much more about saying if you want to be designated as a default pension scheme in the UK, then you should have a globally diversified portfolio, but not necessarily index weighted, which is not diversified because that basically means 70% of your money is in the US with a declining dollar right now. And actually, say 20-25% should be invested in UK assets of whatever description you have. Now, you can then opt out as a pensioner, get your full tax credit in the non-default scheme. But if you want to be in the default scheme, and the interesting thing is we've run scenarios on this. We've actually done a survey on this, or New Financial did. The average pensioner that was surveyed thought that 41% of their pension funds' equities were invested in the UK. It's about 4. Okay? 72% wanted the government to support their pension money going to invest in the companies that were the future that their kids would be employed by, simply put. And
so again, it's the story.
It's perceived as a political risk, but perversely, we have made choices in the last 25 years to actually create incentives to subsidise the cost of capital of the S&P 500, not the cost of capital of the FTSE 350. And most countries in the world look at us sideways. So I genuinely think that the thing that I'd love to see is the confidence to make that choice, to say, yes, we want Britain to be investing in itself again. And I'll say one thing, I have heard the argument, but there's nothing to buy here. Now, you just mentioned Revolut, okay? I see a remarkable number of entrepreneurs up and down this country doing remarkable, groundbreaking things every single day, you know? And I think if you look at it, the major pension funds in Canada, in Australia, the major endowments in the US, the sovereign wealth funds, where do they set up their first office to buy assets overseas? London.
Well, look, you've talked about remarkable fintechs, including your own, and overseas interest. We had the Euronext boss on Bloomberg TV saying that he might be interested in buying the LSE. It's easy to say it on Bloomberg TV. Have you actually had a knock on your door with an offer?
It's not for sale. No, look, I'll be very clear with you. It matters to me that I run the only primary exchange in the London Stock Exchange Group. That means I'm not in the slightest bit conflicted to be the biggest possible advocate for the health of the UK equity capital markets. And I operate in a group that has a market cap bigger than Euronext does. And I've seen what's happened to other exchanges in the group, because it's quite difficult to prioritise one when you own several.
Well, that was the London Stock Exchange Chief Executive Julia Hawkins speaking to our Lizzie Burden. Now let's return to European political community leaders meeting in Copenhagen. Ukraine's President Zelensky just speaking to reporters, saying they need to consider sanctions on Russian oil terminals. President Zelensky also saying that tankers under sanctions are being used by Russia. Now, for more on all of this, we're joined by Oliver Crook, our chief European correspondent. So, Ollie, we were just explaining actually what you think will be drawing on European leaders' attention, first and foremost.
Yeah, Francine, where were we? I mean, basically the main thing that's occupied the minds of European leaders here is that basically ever since the United States has stopped sending checks to Ukraine, they've had to figure out how to finance the Ukrainian war efforts against Russia. And that was what has brought them now until this point basically unwilling to look at legal ways, or saying it was basically impossible to touch the Russian state assets that are currently being held in Belgium to the tune of about 140 billion euros. That has all changed since Trump has become president of the United States, and the Europeans have found that they are basically on the hook to basically fund Ukraine. So as a consequence of that, there is now a large renewed sort of will to try to get those assets and to monetize them in some sort of way, in some sort of creative accounting, in a way that makes it so that it's not actually taking the Russian assets, but using them as collateral against loans that basically the Europeans would furnish to the Ukrainians. The reason that this is really very important from the European perspective is that it sends a signal to Vladimir Putin that basically there are 150 billion euros worth of Russian assets that are going to basically fund the Ukrainian war effort. That means that the Ukrainian military will be funded basically for the years to come, and that if Vladimir Putin wants to wait out the Europeans, he will have a great deal of difficulty doing so. At the other side of that coin, there's been an initiative by the G7 finance ministers meeting that has sort of concluded yesterday to try to find new ways to put more pressure on the oil revenues that the Russians are taking in. So we're having that as a sort of larger effort by that large coalition, the United States being involved in that. And what would be really key there is to start to execute on one of the ideas that the Trump administration has put forward, which is this idea of secondary sanctions on countries and companies that are still involved in buying the Russian crude oil and refining it. And that is something that they're advancing on. They're not there yet in terms of actually implementing them, but that is the statement that we got from the finance ministers of the G7, who are meeting in parallel to the European political community, which is meeting here in Copenhagen, where they're also discussing defense functions, including, Francine, this idea of the drone wall, a very catchy idea by European leaders here, and one that is really put into prominence given the amount of drone activity we've had over Denmark over the last few days, to such a point that the Danish government has banned all the flight of drones over the next few days over this EPC community meeting here in Denmark.
Ollie, thanks so much. Oliver Crook there with their very latest, of course, on that meeting in Copenhagen. Now, coming up, we'll get a view of what family offices are investing in despite global trade uncertainty. We'll be speaking to Citigroup's family office group head, Hannes Hofmann. That's next, and this is Bloomberg.
I am incredibly optimistic about Google's position right now. This is just beginning.
I think in many respects, we're still early innings. These are questions that we get from our clients all the time.
We then have 15 different products that each reach 500 million users. There's a lot of capital that needs to go in. We estimate about $7 trillion. I mean, that's a large number.
Number one, you have an investor base that is very open to want to invest here. Number two, you have, great formation of capital in the private markets and in the public markets to support this need.
A lot of money still needs to go in. It's an incredibly exciting, invigorating moment in the space, and the pace of innovation, I think, has never been more thrilling. But I think that Google has all the ingredients to succeed.
Exactly what the outcome is, I think, is still to be played out.
Well, guests there speaking at Bloomberg's Women Money Power event in London yesterday. Now, nearly 80% of adults worldwide now have access to at least one financial account. And over 60 countries have implemented a national financial inclusion strategy. Queen Maxima of the Netherlands is spearheading efforts to put financial health at the center of how financial systems are designed and delivered. Now, she recently delivered a report detailing the key findings during her first year as the UN Secretary General's special advocate for financial health. Now, I spoke with her on the sidelines of the UN General Assembly in New York last week.
We did a lot of work in the last 15 years to get people access to financial services, and that is actually very good. But the thing is, financial inclusion, access to financial service for what? We want actually, in the end of the day, to become better, to be able to manage the day-to-day finances, to be able to make long-term investments. Is it a pension? Is it a home? Is it the education of your children? We want them, to be, life be improved if they get a shock, health shock, job loss shock, climate change shock, floods, destroying things. And you to feel confident, it's also about mental health. So where are we at now? We know that the numbers of financial health are actually not really great. 31% of Americans are considered financially healthy, so that means the rest are financially unhealthy. In a country like the Netherlands, 1/4 is considered financially unhealthy, and another 1/4 is actually vulnerable. What I mean by that is just this one shock away of actually getting into real financial trouble. And globally, 1 in 3 people actually have enough money to have 2 months of no income. So, 1 in 3 people. So there's a lot of work to be done, and I think that this issue of financial health has been resonating across the board, and because the realities are there.
That was Queen Maxima of the Netherlands speaking with me last week. Now, U.S. family offices are professionalizing their operations, paying their chief investment officer at least $1 million annually. That's according to Citigroup. This push for top talent is matched by a growing appetite for risk, with many family offices embracing private markets and seeking direct equity stakes in companies. Well, joining us now is Hannes Hofmann, head of the Global Family Office Group at Citi Private Bank. Hannes, thank you so much for joining us. It's very clear that family offices are getting bigger with more money, getting organized, and recruiting top talent. How much diversifications do they want? What kind of conversations have you had with the head of family offices?
Look, I think what we're seeing is family offices being a very important and increasingly asset-rich long-term investment segment in the market, right? So what sets family offices apart is really the ability of families to think multi-generational and to take an approach that goes over like multi-decades. And we see that all around the world. So when you're asking about diversification versus concentration, family offices in their investment approach, when we work with them, put a lot of emphasis on diversification, regional, asset class-wise, and in terms of taking risk positions. Now, what we're seeing is 70% of family offices have concentrated stock positions somewhere in their holdings. 78% own operating companies. So there's a lot in terms of concentration already existing. But diversification is a key tenet. Now, what we found this year...
Hannes, but give me a sense, for example, so does it mean that they want private markets more than public markets? And actually, do they worry about valuations in terms of, the asset classes that they want to enter? If they're thinking 5, 10, 15 years down the road, then what are they thinking about today?
What's interesting for us, so we've done this survey 7 years in a row now, so we got a good handle on how things have been developing, and we always get new insights every year. What struck us about the survey that we just published 3 weeks ago was it happened 2 months after Trump's tariff announcements, right. And so a lot of disruption in the market. But the sentiment that family offices expressed was very positive, very bullish on overall returns. When it comes to asset classes...
In what time frame?
1 year time frame. Going forward.
Despite Liberation Day, despite the tariffs, and despite everything, which is quite unusual.
It is very unusual. It's something that some people would not have expected, but of course it reflects a lot of the fundamentals underlying the market. It also reflects that family offices...
AI and valuation.
Yes. So look, what you see is family offices are looking for long-term trends and investments that expose to themes like AI, exposed to themes like security, exposed to themes like healthcare, sports, and really it's become a security selection market. So when we look at what's driving that positive return expectation, people have invested more into private equity, they've invested more into directs and more into public equity.
Hannes, everyone's chasing the same deals. So
Yes.
how are family offices different from, pension allocators, longer-term pension fund? Is it really, if you have a longer time horizon, are you going after the same things? Or is there something about family offices that make them behave differently?
So I would answer, there's two things that we see in the behavior of family offices that set them apart. One is a true long-term outlook, this ability to be able to think 20-year time horizons, and in many cases also to not have a liquidity need within the time because they have operating companies that generate revenue. So we're seeing only 50% of family offices are borrowing at all. The second thing, though, that's important is speed. So one of the things that family offices do that sets them apart from many other investors, because the assets are being held by a very well-defined entity, one family, many of them, in cases where they believe there's real value, can act very, very fast.
Yeah, the interesting is the fact that they're also outsourcing. Is that because of family feuds? So you have someone that's more professional, so it makes the family dinners that little bit more enjoyable?
Yeah, look, I mean, what we found is that about 50% of family offices use outsourcing in one way or the other. I would say in general, from our work in the survey, 75% of family offices have less than 10 employees.
Right.
And we're working with 1,800 family offices around the world, average net worth over $2 billion. So what you have is family offices with not too many staff who then professionalize the investment function primarily, and the other functions are being outsourced where it makes sense. So an example would be cybersecurity, typically outsourced. An example would be asset reporting and asset aggregation, typically outsourced, can be done better by suppliers. So, yeah, we see a lot of outsourcing.
Hannes, thank you so much for joining us today. Hannes Hofmann, they're head of the Global Family Office Group at Citi Private Bank. Now, tomorrow, don't forget, we'll bring you a conversation with the chief executive of Goldman Sachs. Tom McKenzie will be speaking with David Solomon about the impact of AI on building financial infrastructure for the future. That's at 9:40 a.m. London time on Friday. Now, a couple of other things we need to watch out for. Technology stocks driving global indices again to fresh highs. This is a big story of today, and this is after a deal catapulted OpenAI into the world's most valuable startup, bolstering optimism for artificial intelligence. Now, today, there's a lot of news. Packed news, 10 a.m. Euro area unemployment. That's in 3 minutes from now. What's likely delayed is U.S. jobless and factory orders. Then at 3:30 p.m., of course, the Fed's Logan will speak. Interesting right now, given the context also of what we heard yesterday for Lisa Cook. And then 5:30 p.m., ECB's Villeroy de Gallo and Mr. de Guindos speaking from the ECB at 9 p.m. Of course, the Tesla shares. We were fully briefed by our Craig Trudell. A couple of other things we're watching out for. Look, Treasury's mostly holding on to Wednesday's gains. The yield on the 10-year note steady at 4.1%, but it's very clear that the Fed rate cut expectations pulling yields down from January's high. Traders now contending with a temporary blackout in economic data amid the U.S. shutdown. But then at the same time, money markets fully pricing in a quarter-point Fed cut at the end of the month, saying now an 80% chance of a December cut to support a cooling labor market. Up next, it's a Bloomberg Brief, and this is Bloomberg.